Welcome to capstrat this week. I'm Woodall here with Mike Rarey. Hey, Mike.
Hey, Will.
It's a week of 10/30, day before Halloween.
Yes.
Any big Halloween plans?
Probably a lot of pink eye drops, ear infection antibiotics, blowing noses. Outside of that, it's going to snow, so see if we can get some candy before the snow gets too bad.
Trick-or-treating in the snow. That's always fun.
Yep.
Love that. Fun. Great. Awesome. Well, this week we're going to take a look at the returns month to date and year to date and give some perspective on those returns as we've seen a continued sell-off in the equity market. And we'll talk about some of the insights we found in terms of how our recession indicator is evolving and how some of our other indicators are evolving. So we'll start with the returns for equity for the last week and month to date.
Yeah, last week, another difficult week for equities. Notably, it pushed the S&P 500 into technical correction territory, which of course is down 10% or more from the recent high. So from the highs this summer around August 1st, you can see U.S. large cap stocks down 9.94. That's a total return basis. On a price return basis, they're down more than 10. And then small caps, especially small growth stocks, nearing bear market territory, even though they were already in a bear market, but down almost 20% from their highs. Right. And then you see no real improvement in foreign markets either. Emerging markets, particularly China, still investors not at all enthusiastic about the stimulus measures that have thus been announced. I guess everybody's waiting on the bazooka, and Xi Jinping is just not willing to fire it.
And what has led to this downturn, this technical correction?
Yeah.
What factors are actually in the market forcing this to happen?
So in our view, the primary cause has been the rapid rise in longer-term interest rates, longer-term yields. The market is kind of viewing this as we had our initial monetary tightening in 2022, and then from October 2022 through about June, longer-term bond yields were flattish, range-bound, and now they've come up again, and this is sort of the second leg of tightening of monetary conditions, and it's not at the short end from the Fed, it's the longer end of the curve, and it's coming from too much new treasury debt being issued, economic growth being better than expected, and then the Fed not looking like they're going to be cutting anytime soon.
Yeah. Well, let's take a look. There's been a lot of talk about the technical correction and the Magnificent Seven stocks versus the market. Let's take a look at how we progressed here.
Yeah. And so looking at the blue line, the S&P 500, this is since the market high on January 3rd, 2022. You can see the rally through July, and then since late July, the S&P down 10.3%. So we're now at 4117, thereabouts on the S&P. What's been notable this time around is that the Magnificent Seven has been selling off commensurately. That was definitely market leadership there. Those seven stocks are still responsible for all of the S&P 500 gains year to date, but they're down, 11.5% from their high in late July. And, it's not just for no reason at all. Earnings have been coming in. 5 out of the Magnificent Seven have reported thus far. It's been a very mixed bag. Tesla was pretty ugly. Meta gave some ugly guidance. Google was pretty ugly. So, and then we get Apple this week, right? So the market leadership has been breaking down a little bit. So that definitely gives some reason for concern here.
And just why do we measure from the cycle peak versus just year to date?
Right, because if you were to look at just trailing returns, usually you're going to see last 3 months, year to date, which are all, for year to date's very positive. Versus if you're a long-term investor, you're thinking in cycles, right? So in this cycle, since the last market high, you've lost money in the S&P 500. You've actually lost or about broken even on the Magnificent Seven, if you can believe it or not, right? Yeah. So it's in our view, it makes a lot more sense to measure in cycles and look at it in terms of the price chart, but because trailing returns can be very deceiving.
Yeah. And what leads to this big gap between the Magnificent Seven and the market? Like why do we see that
Yeah.
divergence.
Yeah. Well, back in late 2022, you saw the Magnificent Seven underperforming, because they were the growthiest area of the market, and they were the most sensitive to longer term interest rates rising, right? You think about their future cash flows. And so this surprises a lot of people, but the Magnificent Seven haven't always been outperforming, right? As recently as Q4 2022, they were some of the biggest laggards. They were dragging the market lower.
Right.
You would have rather owned the other 493, right? And then as we get out here, then you get the AI boom, and you get that period of longer term bond yields sort of steady coming down, and that's when you see Magnificent Seven take off.
All right, let's take a look at returns in the fixed income space for the period.
And fixed income was a pretty good week last week. Obviously, since August 1st, we talked about longer term bond yields rising. That's been a big reason for the equity sell-off. But last week, especially if you look at the technicals here, you focus in on the 10-year Treasury, you made 0.74% last week. Last Monday, the yield on the 10-year Treasury eclipsed 5%. It moved all the way up to 5.02, thereabouts. And then a big reversal. From Monday afternoon, when we got to 5.02, we went all the way down below 480 yield by the time Tuesday morning came around. A huge reversal in bond yields. And this is something we've been talking about in prior shoots. It seems like if you go through the auction data and you look at the trades, the technicals under the hood, 10 years, 20 years, 30 years, there seems to be demand at or around the 5% range. Don't know if it's necessarily folks initiating outright long positions or covering their shorts, right, at that range. But there does seem to be some technical support for yields at the 10-year, 20-year, 30-year points at around 5%. We'll see if that holds. This is a big week for the bond market, right? So we'll see if that holds this week for sure.
Okay. And then in the alt space for the week?
Yeah, in the alt space, really continuing to see a lot of the trends that we've seen since the Hamas attacks on Israel, where you see things like copper doing poorly, gold doing very well, and then WTI crude still up. So we're sort of using this the commodities market a bit as, the financial markets leading indicator of potential escalation to the conflict. And what it was showing last week is not a tremendous amount of escalation potential week over week. When Israel looks like they're going to start, issuing ground troops in Gaza, it's going to be much more refined and methodical than was initially feared. And so we saw markets sort of view that as a good thing in terms of calming down.
Okay, and then we had a good GDP number last week reported.
Yeah, an incredible GDP number.
You just can't stop it.
Yeah. So the Q3 number, quarter over quarter, seasonally adjusted annualized rate, came in at 4.9. And we've broken it down. These are the last 4 quarters of quarter over quarter. And then all the way out here to the right, you have the year over year figure. And so Q3 is hot. 4.9%, that is more than twice the trend, double trend growth. So by definition, it's unsustainable, unless we get some boom in productivity from AI or something. And you see where the contributions are coming from. One, we had a big inventory build, so that's the orange. That's by nature not sustainable. That's mean reverting, right? Inventories draw, they build. We had a big build. That'll be coming back. So that'll be working against the growth numbers in the next quarter. But more importantly, you look at the dark blue consumption. That was lights out. If you look at Q1 consumption and Q3 consumption, consumers are spending like there is no tomorrow, right? And so you think about the sustainability of that.
Right.
And this goes to something we spoke to at the last video shoot. If you're a net borrower in this economy right now where rates are at, you cannot keep consuming like this. Your savings are depleted. So now you literally either need pay increases, which are not, the current wage increases are not on par with this level of consumption, or you need to borrow. You need to lever up your balance sheet. And that is prohibitively expensive or not even an option.
Not even an option, right.
Right? So if you're a net borrower, this is certainly not sustainable. consumption should slow. If you're a net saver, the hope is, you should be able to continue to consume, with a couple caveats. One, you're less likely to consume because you're a net saver, right? So what do? You save. So you're saving more. You just have a lower marginal propensity to consume anyway. There aren't a lot of you in the economy, right? So there isn't enough to do the heavy lifting. It's a smaller and smaller portion of the economy that has a strong balance sheet that can spend. And then the last piece is, if you're a net saver, you're lending money to somebody, right? That's how you're getting your interest payments, your interest income. Mm-hmm. Well, those people that are lending you the money, they're the net borrowers. If the net borrowers stop making payments because they get squeezed so much, then now that's a difficult position to be in as a net saver, right? And that's when you're going to cut your spending. So we think, and I guess that naturally transitions to here, we think that's the high point for growth for the cycle at this point.
So our forecast for going forward for GDP, next quarter, this quarter, looking negative, positive?
Below 1.
Below 1?
Below 1. Q4, something around 0.5%, we think seems reasonable, just given the excess savings dynamics and the lagged effect of Fed rate hikes and the inventory, draw that's likely going to happen. The Atlanta Fed GDP now came out, first estimate for Q4, and it's looking at 2.3. Okay. So you almost don't even bring that up because it's meaningless at this point, right? But we think that will come down as we go throughout Q4. Growth has been stronger than expected, right? Everybody acknowledges that, but unsustainably strong and taking growth from future quarters in our view. So now we're setting up for falling economic growth, which is typically a pretty good environment for fixed income and not a great environment for equities.
Is the market sort of anticipating part of what you just said, and that's why it's selling down?
We do think that's part of it, right? It's not all about bond yields rising, because the other thing that we're seeing is credit spreads widening. And credit spreads are usually the canary in the coal mine, right? And credit spreads widening suggests, hey, not only are companies going to be refinancing into a higher interest rate environment, they might be having to refinance into a more difficult growth environment. And that means their creditworthiness could deteriorate, therefore credit spreads widen. So there's definitely some concern there as well. Yeah.
Let's move on to inflation and take a look at those hot numbers. They continue to be, hot.
Yeah, for sure. And and we talked about this is going to be a big week for the bond market. Well, there's a Fed meeting this week, right? So you look at our inflation forecasts, and core CPI is continuing to show progress, although ending our 12-month forecast horizon still in the 3s. So that's going to be very difficult. Once again, we suggest this progress on inflation. It may support the idea of no more rate hikes, but it does not support rate cuts yet. If during this forecast horizon there's a recession and a more material slowdown in growth, then the Fed could cut reactively, out of a position of weakness. But this does not, in our view, support proactive cuts, which sets up a very difficult Fed meeting because these are the CPI data points. The Fed watches core PCE, right? And we just got core PCE last week. Yeah. And if you look at what the Fed's looking at, which is look at core PCE, exclude housing, exclude energy, that ticked up a lot month over month. From August to September, ticked up to 42 basis points month over month, right? So you're annualizing something around 5% run rate here recently, this little resurgence in inflation. So once again, if you're the Fed, you may be able to go out there and say no hike today, but you probably have to leave the door open to another hike potentially in December. Even if you're not going to do it, you need to leave the door open. And there's no way, in our view, you can justify opening the door to cuts yet. And
what drove the hot PCE number?
Yeah. Well, we've had this resurgence in services inflation. I mean, we saw the GDP number for Q3.
Yeah.
Right? Everybody was spending money like crazy on services. Taylor Swift concerts and Beyonce concerts and whoever, and you know, Barbenheimer, whatever.
Yeah.
The big summer of services spending, I mean, all that money, a lot of it went to inflate services prices. So the gift and the curse.
All right, let's move on to liquidity, because you know, we've seen sort of liquidity looks like it's improving, but we haven't experienced what the downturn in liquidity meant yet.
Yes. I think that's a great way to put it. We had this big downturn in liquidity. The liquidity numbers all year have been bad, but year to date, they haven't felt that bad. And now it's looking like the money supply forecast, our liquidity forecast is going to improve, but it's probably going to feel worse. And that speaks to another big event that's happening this week, the Treasury quarterly refunding. So the Treasury is going to they're going to come out and they're going to give an estimate as to how much they're going to issue in new debt to fund our deficit. And it's going to be a lot. And it's going to be more than the last time they came out and said they need to issue debt. The key thing is, how are they going to issue that debt? Are they going to issue shorter term maturities like bills, in which case there should be limited market response to that? You know, there's 1.4 trillion sitting in reverse repo that'll probably just soak that up.
Yeah.
They'll just roll out of reverse repo and into Treasury bills. They're probably going to do less of that though, because they've already issued so many bills. They played that card, right?
Yeah.
So what's left is they're going to issue notes and bonds. And what's the issue with issuing notes and bonds? The first is, you know, supply and demand. You increase supply of notes and bonds. Given you know, hold demand constant, what that means is prices are going to go down. Prices go down. That means note and bond yields are going up, and that reinforces the equity market sell-off. So that's the first thing. The second thing, the more important thing, is somebody needs to buy the debt, and it's increasingly the U.S. private sector. And that sucks up savings from the private sector. It's like a liquidity vacuum. And the Treasury is just going to go around and say, yeah, I ran this huge deficit and I didn't ask any of you for any money, right? I didn't even issue debt for the first 6 months of the year because of the debt ceiling. So you could keep your liquidity and you could put your savings in the equity market and the economy or whatever. But now the bill's coming due. I need to fund this deficit. Give me your cash. Give me your savings. I'm going to suck it all up. And so that is why it's going to feel worse now, because of these dynamics. So that's something we're watching very closely.
And so explain that a little more in detail. I think first with the difference between notes, bonds, and bills, so people have context of what that means. Yeah,
so your bills, they're issued at maturities less than a year. And then your notes are 1 year out to 10 years. And anything longer than 10 years is a bond. I think that's exactly right. Somebody can fact check me. But generally, you know, bills are shortest term. I think notes are like intermediate term, and then bonds are longest term.
So we've exhausted the bill side. And are there limits on how much of each the Treasury can issue?
Yeah, there are guidelines, so which is an important distinction because they're not hard and fast, right? So the guideline that's been issued is that Treasury bills should not represent more than about 20% of total debt outstanding. And that guideline is there for a reason, right? Because you as a country don't want to be in a position where a huge amount of your debt is maturing within the next 12 months.
Right.
That's a vulnerable position to be in, right? You don't want to be relying on that a lot. And it's the most expensive debt on the curve to issue.
Right.
It's where the highest yields are. So we're at that limit. We're at 20%. The issue we have now is, even though we're at that limit, that is the safest place still for the Treasury to issue new debt without sucking up liquidity from the market, without disrupting markets, without creating any stress. So they could do that. They could say, screw the guidelines. I saw the volatility that I created over the past 3 months by issuing all these notes and bonds. I'm going to give the market a breather, right, and just issue bills. But they can only do that for so long.
Yeah.
Right? Unless they solve the deficit problem. Right? And we have a new Speaker of the House, so maybe.
Yeah, good luck with that.
Yep.
Okay, let's move on to the recession update, because we do have signals triggering, and it's looking more and more like we're approaching potentially a recessionary period.
We have some action here. So, reminder, there are 4 underlying signals: yield curve, real economy, labor market, and market stress. The yield curve has been active. It's been active for a while now. It's still active. Longer term spreads, you look at the US Treasury yield curve, the 10-year minus 3-month is inverted, the 2-year minus 3-month is inverted. Real economy and labor market, we are seeing some weakness in the real economy. You know, you look at housing starts, we had that big recovery in housing starts in the spring when mortgage rates were, you know, in the low 7s, high 6s.
Right.
And the spring is a seasonally strong time for housing starts anyway. That's starting to fade. So you'll see some orange in the real economy signal, but nothing triggered yet. We've had a recovery in the labor market in terms of initial jobless claims, right? Those had spiked in the spring and now have come back quite a bit.
Right.
But markets are starting to stress out, right? And this is why, I mean, this is somewhat of an issue, right? Because the S&P 500 is down 10% or more. That never happens just for no reason. Okay, there's something there, all right? Commodities, you look at the copper-gold ratio, it's triggered, it's down 20%. And so then the kicker here is credit spreads. And if investment-grade corporate bond spreads were to widen out another 7 bips or so, or 9 bips, or if high-yield bond spreads were to widen out another 32 basis points, then credit spreads would trigger as well, and that would trigger our whole market stress signal, which would mean if market stress is active and yield curve is active, then 2 out of the 4 are active, and then our entire recession signal activates. So, you know, I think in our view, that's a big reason why it is too soon to go out there and say, hey, let's try to buy this dip.
Right.
Because credit spreads are saying there's actually something fundamental going on here, and if you want to go and plow your money into equities right now, you might be doing it right before the recession signal activates, which, of course, we would say is not a good idea.
Right. And so we're at 4,100 recession triggers. What kind of equity down trend or potential downturn would we have?
Yeah. Well, you would think naturally you'd retest the lows from last fall.
35.
And then we take it from there.
Yeah.
Right. Because as we were in last fall, well, you think about bond yields were lower than they are now. Right. The Fed funds rate was lower than it is now. But recession fears were higher back then. So if recession fears come right back to where they were last fall and some, then we think naturally you would retest those lows.
So that's probably 15% from where we are today.
Yeah.
So a lot of downside potentially.
Yes, potentially.
So another reason why we would wait to buy.
Yeah.
Okay. Good.
So there it is.
It's a good update. Appreciate you joining us this week. If you have any questions, reach out to us or contact someone in the Private Wealth team. And we'll be back next week.